Okay, all right. Guys, thank you so much for that. I have with me Mr. C.S. Setty, Chairman, State Bank of India. Sir, thank you. As always, it's a pleasure to have you with us. And thank you for taking the time out. If I may begin, sir, with the expected credit loss guidelines finally out from the Reserve Bank of India last night. Broadly, is it on expected lines? And some of the changes, especially when it comes to stage 2 assets, are quite different from what banks are doing on special mention accounts at the moment. What will be the impact? What is your initial assessment?
The ECL guidelines are broadly as we expected. Of course, in fact, there are the draft guidelines also I had mentioned in terms of increased provision requirement for stage 2 assets.
Yes.
Stage 1, stage 2 concept is anyways there in the non-banking finance companies, right?
Yeah.
They moved to IFRS. Yeah. This ECL guideline broadly aligns with the IFRS 9 requirements. And there are a lot of nuances there in the kind of risk weights what we have to follow various categories of loans.
Yeah.
We would be evaluating that. I think it just released last night.
Yeah.
But so one important thing we need to remember is that there are a long transition period.
5 years.
5 years, and also banks like SBI, based on the draft guidelines itself, we have put the technology, our models, PD, LGD, and risk assessment models in place. So the transition should be smooth, both in terms of the adoption of models, as well as managing the balance sheet impact. I believe there will be a limited impact on the bank's balance sheet.
But sir, that said, for stage 2 assets in particular, at the moment, the comparable SMA2, banks are only providing about 40 basis points.
Yeah.
Now, RBI is talking about 1.5% to 5% kind of provisioning. How much additional capital do you think you'll have to step up, keeping in mind how large the SMA book for you currently is? And of course, in future to take care of that?
No, we haven't assessed yet in terms of the real impact of this. But I broadly feel that the couple of things what it expects is that recognize wherever there is some risk there, and then you provide for it. While we have done proactive provisioning for SME loans, for instance, during COVID, we were expected to make 5%, 10%, but we went ahead and made 35% provision.
Yeah.
So some of us have been proactive in terms of making provisions on SMA category loans too.
Yeah.
But this will structurally, alter the way we look at, more importantly, in terms of managing the SME accounts, and strengthen our collection mechanism, ensure that an account doesn't move into the 60-day DPD.
Yeah.
So it also calls for institutional capability to create a very strong collection mechanism in the bank.
True. Yeah. So on the Basel III framework, again, risk weights, there have been changes across the board. If you talk about real estate for affordable retail housing loans, the risk weights are being reduced. For commercial, they've been increased. For MSME, they've been reduced. For better rated NBFCs, again, they've come down. And credit cards. What is your overall assessment on what kind of credit this could unlock, and how much additional capital will there be for you to lend to these sectors?
The credit capital constraint was never there. I think most of the banks are well capitalized to support the credit growth. But this is a very welcome step. In fact, all over the globe, the risk weights on the secured loans, which have happened in terms of the LTV-based risk weights which have been prescribed on the real estate loans, particularly on the residential mortgages. I believe that we had one of the highest capital allocations for our residential mortgages across the countries. So that has been now, I think, is aligned to global practices. This is a very good move because I think most of us have very significant residential mortgage portfolio now. And it also recognizes the risk element in a commercial real estate. So while the CRE portfolio when compared to the residential mortgage is limited, but I think this differential approach was required. And in terms of MSMEs, again, I think a lot of capital will be released in terms of, otherwise it was a uniform, most of the loans used to attract 100% risk weight.
Yeah, now I think
there's a 80%, it's 80%. So, and that's definitely a positive. So it's the ECL and the whole risk weights, Basel III norms have to be looked in holistically, and we have to assess the overall impact.
Okay, sir. In that sense, then, given all of these measures plus the various reforms announced by the Reserve Bank on the 1st of October, you think you could meaningfully revise upward your credit growth guidance? I know we keep asking you this, but there are more and more of these new measures coming in every day that we speak. You think there could be a meaningful uptick?
No, no, definitely. I think a lot of this, I called in one of your shows that these announcements are, I call them as banking reforms 3.0.
Yeah.
And these reforms are, for a long-standing demand from the banking industry.
Yeah.
And very proactively addressed by the RBI.
Yeah.
I believe that they're absolutely credit accretive. If you really want me to put a number, I said that 1 to 2% credit uptick. Additionally,
over and above 12%.
Over and above 12% is what, for the industry, not necessarily for SBI. I am very, very positive on that count.
And so capital financing, you've welcomed the move, and I know you personally have presented this proposal as well from IBA to the Reserve Bank of India. Now it has been accepted. But some of the constraints or some of the reasons why RBI had refrained from allowing banks to do this before was they wanted capital to be used for more productive measures, less so for one promoter acquiring and expanding an existing facility. What do you think has changed to prompt this kind of a move, and how does it benefit the banking system?
No, we are now witnessing a good quality balance sheets, both on the corporate side as well as on the bank side, right? We've been talking about twin balance sheet advantage for the last 4 to 5 years in terms of how the balance sheets have been cleaned up. That is number one. Number two, I think the allowing many of these elements, mergers and acquisition financing, is a confidence which is reposed in the Indian banking system. Ironically, which I've been presenting is that an Indian company acquiring an overseas company is permitted to be funded by overseas branch of India.
Not Indian banks.
Indian banks, Indian companies acquiring Indian companies, not to be funded by Indian banks, I think is a kind of an anomaly.
For IBC, that was the exception.
That was an exception. I think stretched asset funding was allowed. But allowing this kind of funding shows the confidence which the regulator has in the banking system. And I also mentioned in many forums that the large banks like SBI have the capability to assess this acquisition activities, and there are a lot of enablers now, and the data is available. It's not that the acquisition happens in thin air. I'm sure that we don't need to be unduly worried about any capital misallocation, number one. Number two, the risk misrepresentation.
Got that.
I think
But will it reverse that dip we saw in corporate loans from SBI? You have the 7 trillion pipeline, but is it getting converted? How soon before you get back to double-digit corporate growth?
So the corporates, again, as I mentioned, is not only in terms of the pipeline. Pipeline is strong, but many of them have taken the credit lines, have not been utilizing credit lines because they have very strong cash availability to them, and they are consuming that cash before the limits are utilized. But I believe that a lot of statutory, fiscal as well as regulatory measures which are now announced would be very, very positive for the corporate credit growth.
All right, we'll wait to hear, sir. Briefly, in terms of the second quarter specifically, the biggest challenge for banks is going to be maintaining their NIMs because the rate cut effect from RBI comes into play. Do you have enough levers to cushion the blow?
No, I still am holding the view that NIM trajectory, which we mentioned that it will be a U-shaped curve. I think with adequate liquidity available and the cost of deposits overall in the system coming down, I think the NIMs will be, exit NIM will be protected.
So you're already crossing 67 trillion of your loan book. You're more than 20% of the entire system advances or deposits. What is the aspiration? What is the big thing to look out for from SBI in the coming year?
The immediate thing would be that, if we really have to think about a milestone, we look at business levels, both on the deposit side as well as loans. If you combine, I think we would be reaching 100 lakh crores this year. That would be a big milestone for us. In terms of scale, I think is unprecedented scale.
Okay. So one last question, since I spoke to your former colleague, Mr. Prashant Kumar, yesterday, and that SMBC transaction now being concluded, you've made some handsome gains, but you still continue to hold on to more than 10% stake in Yes Bank. What are your thoughts on that? Would you want to keep it for much longer?
No, that's a call which we will take as we move forward. I think there's neither any compulsion to hold nor any compulsion to exit. So it is purely our call, and we'll take it at appropriate
Which is
time.
what we're asking you, sir. What is your call?
So now at this juncture, we have not made any call on that yet.
All right. So finally, if I may ask you a last question, because it's IPO season, a whole host of companies going public from Tata Capital, to others. Your own companies in the pipeline, we've been hearing for a long time: mutual fund, asset management, general insurance.
They're still in the pipeline. So
When, sir? When do we see
I think
unlocking value?
we'll just see the evolution and evaluate the opportunities.
Not in the next calendar year.
Don't give any timeline on my behalf. I think let us keep it that way.
All right, sir. Thank you so much for your time. It's always a pleasure speaking with you. Thank you, sir.